Good morning, gentlemen. Thank you very much for your time once again. It's always good catching up. In terms of what we're seeing, it's such volatile times. We're not seeing any sort of direction. I mean, there was talks of a possible vaccine earlier on this week, which obviously stimulated market performance significantly. We saw that pulling back once again the day thereafter. And this morning again, we saw the JSE as an example pulling back quite sharply. For obvious reasons. So without going into too much of the detail in terms of what caused the actual performance on a daily move or actual movements on a daily basis, Pierre, could I ask you just to give us a bit of feedback in terms of what we're seeing? I mean, we saw the markets pulling back towards the end of March, based on the fresh news and the actual impact and estimations of COVID. And thereafter, we saw what you referred to previously as a so-called dead cat bounce, where you saw a very quick and sharp recovery. We wonder, however, and we've spoken quite comprehensively about this, whether this is sustainable and whether we see recovery, and what V-shaped recovery mean, and are we possibly seeing a W, or are we going to see a U-shaped recovery? Maybe just give us some background from your perspective, in terms of how you interpret what's going on.
Okay, thanks, Luciano. Yes, as we previously said, after the market fell significantly in March in the first quarter, it basically stopped falling on the 23rd of March, and there was a sharp recovery. And that was really after the US Federal Reserve and other reserve banks stepped in quite aggressively to put liquidity into the market. Since we've had this recovery, as you mentioned, but now the market the recovery is maturing a bit, and I think the realities are dawning, and we are realizing that COVID is in all likelihood not something that's going to go away in 1 or 2 quarters time. There's lots of optimistic things to point to. I just read last night again that there is no fewer than 100 COVID vaccine kind of projects on the go globally, and there's a number of them already in human testing, and there's been some fairly positive reports in recent days. So I think that's on the positive side, but I think on the negative side, and that's maybe what's kind of dampening the market and frankly causing the volatility that we see, is that people realize it's going to take time. Even if it's a vaccine, we're probably looking at 6 to 12 months minimum for a vaccine, because I mean, once you get the thing, you still need to roll it out successfully on a fairly kind of large scale basis. And the market is just looking at this and saying, economies need to open, but there's very much uncertainty as to whether you do it successfully. We're now going to experiment with opening markets, but there's a lot of noise around it, and the best example of that is maybe in the United States, where it's really becoming a politicized issue, and in South Africa to a lesser extent, but also, so some people feel, people are going to die from hunger if economies don't open aggressively, and what does it matter whether it's that or whether it's COVID? But then I think there's other people that are a lot more kind of cautious about it and look at it and say, listen, if we open up too quickly and too aggressively, and we then just need to move back to aggressive hard lockdowns again, then you really get stuck, because then you go, 3 yards forward and 2 yards back. So I think that is the problem. And there's been interesting research coming out from macro research guys who've modeled the medical side of it, the curves of the infections, and the death rates, and try to infer from that what are the safe dates where you can start opening up economies. And interestingly enough, for most of the world, it is round about the time where we are now, mid-May to mid-June, to what they call sustainably start opening up. But for all countries, it's going to be this tiered thing like we have in South Africa, 5 levels or whatever, and really experimental. One worry is the US, and I think that's why there's so much political noise, because this modeling basically indicated that although New York State leads the US in terms of the development of the disease, they are further down the line. The rest of the US states are lagging, and safer opening dates for them is much later in the year or even early next year. So it does, from an analysis of the medical side, seem that President Trump and people who are pushing for aggressive opening is a bit overzealous, and therein lies the risk. But I think the time will tell, and the numbers will show whether that is being overly optimistic and too quick. So I think that's the one aspect. And the other aspect, maybe to conclude, is that the markets have recovered or bounced because of massive liquidity and maybe optimism about the containment of COVID. But what we've seen and what have, in my view and our view, been creating the most recent volatility is that there's now a big gap between what the market have discounted in April by going up quite strongly and the economy and the economic numbers that's coming out, which is quite bad. And the bridge between or over that gap between the market and the economy is the global stimulus by the banks. But now the question becomes in everyone's minds, is this bridge long enough, and will it be able to extend if this gap opens further, if the market moves further away from what the real economic numbers seem to signal? And frankly, is this bridge strong enough, and can they sustain it? So I think volatility is unfortunately to be expected for the next year at least. The easy part of the recovery on the back of the initial massive stimulus has happened. It's not to say the market won't go up from here. We don't expect it to test the lows of March again because of the stimulus, but I just think we're going to see a lot of volatility.
So Diaan, in terms, thank you for that, Pierre. I think so volatility obviously creates during these uncertain times, volatility could be seen as possible opportunities as well, I assume. And surely from a strategic management perspective, Diaan, maybe if you wouldn't mind giving us some feedback in terms of Naviga's approach, relative to the volatility, how have we considered rebalancing, repositioning the portfolios in order to, one, obviously protect client capital and wealth, but then also, enhancing, asset allocation and possible upside during these periods?
Hi, Luciano. Yeah, so there are opportunities available, and I'll go through the portfolios, what we're changing to it, and where we see the opportunities lie. Just to start with SA Cash, yesterday they reduced rates by another 0.5%. So the call rate is now only at 3.5%. So that is below inflation. So cash is not an option anymore. Cash delivers less than inflation. So cash is not an option at the moment. So what we prefer flexible income fund managers because they've got access to all these instruments like bonds, credit, inflation linkers, listed property and hybrid instruments. And they can enhance the yield by investing in these asset classes. So money market is not an option, but there are other fixed income instruments available to enhance the return.
Diaan, could I just fall in here? Maybe, but I've been inundated with requests from clients, and I'm going to use this opportunity to just elaborate on that. I mean, so if you wouldn't mind just going back to the previous slide. So the question remains, and this is the question from clients: should we switch to cash? Should we sit and wait in interest-bearing instruments rather until the dust sort of settles? And my feedback has been, though, even on the prior rates, one has to remember that I think this, according to Stats SA, currently, and please correct me if I'm wrong, the current inflation rate communicated is around about 5.17, I think. But what clients has to bear in mind, and when I send this out, it's imperative for them just to understand. So the actual inflation rate varies between person to person because everybody sort of buys a different basket of items. And I think realistically speaking, one's inflation rate should really be higher than the 5.17 in our client base specifically. Which brings us to a guaranteed loss. Any exposure, in my view, to cash should in these sort of environments be seen as a guaranteed loss. Do you agree with that statement?
Yes, definitely. So if we look at the inflation basket of South Africa, that's currently at 4.1%. But that's not it's not to say that that basket is applicable to everyone. For example,
Yeah.
I think many people spend much more on healthcare, education cost, transport, and electricity as well. And all those costs increased by way more than 4.1% in the last year. So one must be careful to assume that the inflation of 4.1% is applicable to everyone, because many of the underlying drivers of inflation is much higher than the 4.1%. So now cash will provide only 3.5% return. If tax is applicable, that 3.5 will reduce to roughly 2%. So 2% will not be enough to compensate for inflation.
Good.
So if we look at the different instruments that flexible income fund managers can invest in, it's especially bonds that provide attractive yields. So on the shorter end, bonds deliver about 7.2%, and in the long end, bonds deliver about 10.6%. So cash is at 3.5%, shorter bonds is at 7%, that is double the cash rate. Long-term bonds, 10.6%, that is 3 times the return you can achieve from bonds than from cash. So you can see there's definitely opportunities in bonds. It can be volatile, and that's why we prefer to have flexible income fund managers that can actively move between cash and bonds and to enhance the yield for our clients. But cash on its own is not an option. Here's an example of what flexible income fund managers expect for the next year. After yesterday, they cut the rates by 0.5%, and the expected yield on an income portfolio is 7.1% before fees. On money market funds, the expectation is that will reduce to 4.5% and even lower. So as you can see, a flexible income fund manager can generate a much higher yield than a money market fund or just cash at the bank. On property, it's extremely cheap at the moment, but there are obvious risks to property. Rentals will decrease, the long-term growth will be lower. There's companies that's closing stores, and consumer behavior is changing. Many people now opt for online shopping, they're not going to malls, and less office space will be required. People will work from home, and less office space will be required. But property is so cheap at the moment. Even if property companies lose 50% of the rentals for the next year, the return expectation is still high at 23%. So it's tempting to go into property. It's extremely cheap, but there are obvious risks, and we opt for to be more conservative and rather to be neutral to underweight in property despite these attractive valuations. But there can be a short-term recovery in property. On equities, in South Africa, it's cheap, but definitely there is a risk that this lockdown will persist for longer than expected. But generally, our equities are extremely cheap. Globally, there's also selective markets that are cheap. But within equities, what we decided to do is to switch to the quality investment style. Now, a quality investment style is companies that would withstand these crises, and they've got enough cash on their balance sheet or competitive advantage to survive this crisis. So as you can see, the quality managers in the red line protected capital better than those value fund managers that opted for cheap companies. So we're in the process of increasing that exposure to quality because the outcome of COVID-19 is uncertain, and we would rather allocate more to these quality companies. They will lag if markets recover. For example, in April, all the value fund managers perform much better than quality managers. But when the market is volatile or if markets are going down, the quality managers will provide better protection than value. On the currency, we would also like to highlight the risk of the currency. It did benefit our clients during the last year. It weakened by about 30% in the first quarter, so it did provide additional return to our clients' portfolios. But the rand is currently more than 40% undervalued. And one must be careful now to invest in US dollars because the dollar can weaken and the rand can appreciate, which means clients would lose money in offshore assets. And we can see that happen many times in the past. In '86, our currency was 50% undervalued. 2001 it was 67% undervalued. 2008 it was also undervalued by 30%. And every time the currency came back to fair value, which is the red line. Currently there's obviously SA specific risk, and we don't expect the rand to come back to 13 rand, which is the fair value. But even if the rand is only 20% undervalued, the currency should come back to about 16 rand. So 16 rand is a better valuation for the rand than the current 18 to the dollar.
Can I maybe just come in there and say as well, to add to that, the weakness of the rand in the first quarter by almost 30% was not a SA specific story. It was an emerging market story in general. And that's particularly the reason why we think the rand can come back, because the excess weakness, and let's call that weakness over and above, 16 rand, between 16 and 19, was really not driven by South Africa. It was driven by emerging markets generally. And should that change, as Diaan said, due to a dollar weakening or China, for example, coming out of this recession first, growing more aggressively and pulling the other big emerging markets with them, that can cause the rand to strengthen by at least 2 or 3 rand, irrespective of what South Africa's own fundamentals imply. Thanks, Diaan.
So we actually saw that, Pierre. Maybe if I could also just add on. So we saw post the downgrade and in terms of the communications by Moody's, the rand didn't really move at all. I mean, the local market weren't necessarily affected. And I think that sort of backs what you are referring to at the moment.
Yes, you're absolutely right.
Yeah.
So I just want to say you're right on the bonds as well, because South African bonds, they'll all be lost 13% in value in the first quarter, but it was perfectly in line with other emerging markets, and it came back in April. The yields came back with other emerging markets. So these big moves where everyone move in sync is what's been driving the market in the recent past, not country fundamentals specifically.
I understand. Diaan, maybe just in terms of what you pointed out, is there so in terms of the rand weakening, strengthening rather relative to the dollar, or the dollar might actually just weaken relative to emerging economies, the opportunities from an offshore investment perspective are so much greater than what we have in South Africa. Is it not an investment case to build around that? So even with a softer rand, relative to the opportunities available abroad and the scope thereof and the width thereof, is that not an investment opportunity that one should really consider?
Yes,
so when you're buying an
definitely.
offshore, so the currency has been discounted by 30%, which is correct. But I mean, so are you not buying quality assets offshore at a lower discount to the 30%, possibly?
Yeah, so definitely globally, the quality of the companies are much better than in South Africa, and they've got a bigger market to operate and to do business in. But we just want to highlight that despite global equities that's attractive, you can lose money for many years on the currency. In the 80s, it took about 5 years to break even on the currency. In 2001, it took almost 16 years to break even on the currency. So one must be careful. Yes, there are opportunities in global equities, but the currency might detract from those returns. So although you make a gain on equities, you'll lose on the currency. And it can take many years for currency to get back to those levels. If you have a long investment horizon of 5 years and longer, yes, the currency should depreciate over long term because our inflation is higher than the rest of the world. So if you're prepared to invest for 5 years and longer, global equity is a good place to be. But just just remember that the currency can appreciate over the short term, and then over the short term you can lose on the currency.
Fair enough.
So the approach that we prefer to take is one of balance, Lucian, and I think that's what you've been hinted to as well. So what we're saying is we don't want to be at absolutely maximum foreign exposure. So if we can maximum by regulation have 30, we currently don't have that. We have 25 or less, or in the mid low 20s, just to have a bit of a buffer against the strengthening rand. But then within that 20% odd global that we do hold, as Diaan said, we're tilting a bit more to the quality managers, which typically buy the companies like global tech that has been more defensive and global healthcare that's been more defensive. So absolutely, I agree with you. Overseas, you can access the Apples and Googles and the biotech that you can't access locally, and certainly we want to do those, and they have been more defensive in this period, hence the tilt. But one must also remember those are not typically the cheapest shares, so they have almost more growth characteristics together with quality, and you pay up for them. But they do work very well in these uncertain times, because clearly remote working and tech that benefit from that has been supremely important in this period.
So we've made the following changes to our model portfolios. In Naviga Income, we increased our bond exposure in April to benefit from higher yields from bonds versus cash. In Cautious and Balance, we increased the quality exposure, and those type of funds is 91 Cautious, Managed and Opportunity, so they are more defensive than your typical balance or value fund manager. In Naviga Flexible, we reduced property exposure in April by 5%, and we allocated that 5% to Allen Gray Bond Fund. And in Naviga Growth portfolio, it invests predominantly in the offshore market, and we reduced the offshore exposure by 5%. We still slightly overweight offshore, but we took some profit from that offshore component and allocated to domestic assets. In our post-income series, we use a silo approach where we divide assets into short, medium, and long term. And what we're going to do now is take some assets away from the long and medium term silo and transfer it to the short term silo. So we're going to allocate more to flexible income funds. As I previously mentioned, is that bonds offer good value at the moment, and we want to allocate more to those flexible income fund managers that can generate inflation plus returns. Cash is not an option at the moment. We are reducing the medium term component, and on the long-term component, we are adding index funds. Index funds will reduce the cost of a portfolio. We're adding Prescient Core Equity, Netgroup Core Accelerator, and Satrix MSCI World Index, and all those funds have a low cost and will decrease the fees of a portfolio, and that will benefit investors. Passive or index funds, they also tend to perform very well over the long term, especially when markets recover. Index funds tend to deliver very good returns. So that's roughly the changes we've made. We increased the bond exposure, we reduced the offshore exposure slightly, and we added passive and index funds to improve our diversification and to reduce the cost of a portfolio. On the global side, we are also increasing quality and we're adding index and passive fund to the global equity fund. So to summarize all the changes, we see opportunities in bonds. Don't be in cash. Property is extremely cheap, but there are obvious risks to property, so one needs to be careful. On equities, it's cheap, and if you've got a long investment horizon, there's definitely opportunities, both domestic and global. One just needs to be careful on the global exposure that over the short term the rand can appreciate, which means a loss for a local investor. But if you invest for 5 years and longer, the currency should always depreciate because our inflation is higher than most developed markets. And then lastly, we increasing the quality exposure just as a defensive building block in all our portfolios. Because the outcome is uncertain, we would rather allocate to quality more and reduce the exposure to value fund managers. So that's in summary all the changes we've made to the portfolio, or will do within the next week.
Well, thank you very much, Diaan. That was very comprehensive and to the point. I think just to emphasize to our clients, the actions that we've now taken is obviously considered and it has gone through a thorough process of analysis. So the basis on which this Naviga value proposition is built is that the quantitative and qualitative components of these moves have been thoroughly analyzed by a team of investment specialists, and that is then presented to our investment committee, for input as well. After which, consensus is then achieved and rolled out throughout the portfolio. So please rest assured that we are doing our utmost best to manage your wealth through these volatile times. And we are just as committed as we were previously to your wealth protection and enhancement of capital. Thank you very much for listening to us. I hope it was insightful. Pierre, I don't know whether you've got anything to add relative to what we have pointed out and discussed.
Yes. I maybe just want to say one last thing about volatility, and that is that the kind of volatility that we're now seeing on a daily basis and a weekly basis in the market is the kind of numbers that we saw per year almost return-wise in the last 3 to 5 years. So I would advise investors not to look at their statements daily, because you're going to drive yourself completely mad. We are long-term investors. We manage these portfolios with long-term goals and outcomes in mind. We make the changes that we feel we need to make based on both the macro side that we assess and the valuations, but we don't tinker with these portfolios on a daily basis. And frankly, investors should not look at their values on a daily basis, because really they will drive themselves nuts, because to see the South African market up 3% one day and down 2% the next day, and so it goes, is not something strange in these times. Volatility is going to be with us, and we will all need to show fortitude and a bit of a longer term mindset, and we'll get through this. Valuations is on our side. Human ingenuity is being thrown at the COVID problem. We will prevail, but it is going to take some time and some focus on the longer term.
Absolutely. Thank you very much for that input. And gentlemen, thank you very much for the presentation. It was very insightful, and I'm convinced that it will add value to our mutual clients' wealth portfolio.
Thanks for the opportunity.
Opportunity.